Hi everyone, my name's Ashley Meller. Welcome to today's webinar on change of ownership obligations. I'm the manager of the Business Improvement and Regulatory Reporting team, and today I'm going to be talking to you about new change of ownership obligations that apply from the 31st of October this year. Before we start the session, let's talk about how the webinar system works to get you familiar with that. You will have joined the session using your computer's speaker system by default. If you would prefer to use your phone to listen to the webinar instead, select telephone in the audio pane of your control panel. You should have a webinar control panel displaying on your computer, and the dial-in information will be displayed there. During the webinar, you can also submit questions by text. You'll do this by typing them into the questions pane of your control panel. You can send in questions at any time, but we'll address them during the question and answer session at the end of the presentation. In relation to questions, please keep them broad and relevant to the entire audience. We're unable to answer specific questions about individual change of ownership cases. Individual questions would be more relevant and appropriate to email to our inquiries line, and I'll give you the contact details for those at the end of the presentation. So lastly, just before we get started, this webinar is being recorded and we'll be emailing you the recording of it within the next few days. So today's webinar aims to provide useful information on what ASQA actually regards as a change of ownership, because it has a specific meaning when we use those words change of ownership, and some people might think that they mean something different to what we're actually meaning. We're going to talk about ASQA's new processes in response to a change of ownership that have come into effect from 31st of October. We'll be looking at the scrutiny that ASQA applies after a change of ownership, and also things to consider if you're looking to purchase or you're acquiring an RTO or a CRICOS provider. Now, I will slip into using some acronyms during the session, but RTO is Registered Training Organisation and CRICOS provider is the name of a provider who delivers to international students. I do have fuller descriptions on some slides of what those acronyms mean. So let's just start by looking at what ASQA means when it uses that term change of ownership. So when we're talking about a change of ownership, we specifically mean when a change of company shareholdings occur. So we're talking about typically a proprietary limited company. For example, a proprietary limited company might change 10% of its shareholding or 50% of its shareholding, and shares might be sold, assigned, or transferred, so there's not always a sale or purchase. So essentially, a change of ownership is a change to company shareholding, and the change of company shareholding applies to RTOs or CRICOS providers company, but it also applies to any parent companies or the ultimate owners. So a change of shareholding might happen at the RTO level or at a parent of the RTO level, for example. Now, when shares are sold, assigned, or transferred, the legal entity doesn't change, and an easier way of thinking about that is the ABN does not change and the ACN or Australian company number does not change. So a slightly different situation that's highlighted in green on the slide, just to make it clear, is you can't actually transfer RTO or CRICOS registration from one legal entity to another. So if the ABN or the ACN number does change, then that is not a change of ownership. That's not what we're talking about today. So I'm also going to define another term, and that is what we're calling a significant change of ownership, because some of the requirements that came into effect on the 31st of October only apply to a significant change of ownership. So what we're talking about here is when 50% or more of the company shareholdings have changed and over a 12-month period. So they might have changed 10% of shares on month 1 and 40% of shares on month 3. That constitutes a significant change of ownership because we've had 50% or more over a 12-month period. So just because when we do talk about change of ownership, some people can think it might mean different things in just the way that we use it in the, the sort of English language sense. So I'm going to run through in this slide a list of things that we're not covering in today's webinar because they're not considered to be a change of ownership. So the first one to talk about is a change of legal entity. So when we see a change of ABN or ACN, then that is not what we're calling a change of ownership. So if you like, that's company A and company B. They both have different ABNs and ACNs to each other. You can't transfer the RTO registration or sell the RTO registration between two different legal entities like that because it's not transferable. In those situations where you have sort of company A and company B, then the company that is not the RTO or CRICOS provider would need to submit an application for initial registration, and company A that was seeking to not be an RTO or CRICOS provider anymore would still need to submit a notification of material change form. So we're not talking about change of legal entity today. The second one that's not a change of ownership is a merger of two RTOs CRICOS providers. So that's where you've got two organisations that are both RTOs. In that instance, one of them would essentially change their scope if required to make sure they had all the training products on their scope that covered both RTOs, and then one of those RTOs would withdraw their registration. The other one that's not a change of ownership is a change to CEO or PEO. So it's just a new person with that title in the organisation. So Chief Executive Officer we talk about in the context of RTOs, and Principal Executive Officer we talk about in the context of CRICOS providers. Changes to trustees of any trust associated with the RTO. That's not a change of ownership always. That one can be a bit more tricky. And change of board of directors is not a change of ownership, neither is changes to high managerial agents, executive officers or directors. So I just wanted to be quite clear that we're not talking about the items that are on this slide in today's webinar. So when I'm talking about new requirements coming into effect from 31st of October, they don't apply to these changes that are on this slide. All of the changes on this slide do require the RTO or CRICOS provider to notify ASQA of the change, because it is still a change using a notification of material change form, and that's on the ASQA.net portal that all providers have access to. So now we've clarified that, we will move on now to look at what ASQA's new approach is specifically to change of ownership. So the changes to shareholdings of existing RTOs and CRICOS providers. So these changes take effect from 31st of October. That date is the date that the sale or transfer occurred. So if you're selling or transferring shares, you will have an effective date. It's normally noted in your or ASIC will keep a note of that date. It'll be recorded in the ASIC's register. So the new approach we're taking to change of ownership will apply to any sale or transfer from 31st of October, and it aims to ensure that new owners or people whose ownership share is increasing are resourced to deliver quality training and assessment, and that they understand all of their obligations. So it's a bit of a risk otherwise if shareholding changes, particularly when it changes significantly, and the new owner is not able to maintain the high quality of training and assessment that might have previously been provided. So we've also got new notification timeframes for CRICOS providers that change ownership. And there's new evidence requirements that apply for significant changes to ownership only. And the new evidence that's submitted will be checked via an audit. We'll go into this in more detail in later slides. And there'll be increased scrutiny for 12 months on a provider after they've significantly changed their ownership. So that's our ASQA's new approach to change of ownership. The next couple of slides are just going to talk about what has not changed. So changes of ownership should still be notified to ASQA via the notification of material change form, and that's on the ASQAnet portal. That's the same. If a training provider is registered as an RTO only, the notification timeframe also hasn't changed. So you need to tell us as soon as practicable after the event occurs, and that's a maximum of 90 calendar days after the effective date of the sale. When you fill in the ASQAnet material change form, it will check what type of change it is, and it will ask you for evidence that's appropriate to the type of change. The notification of material change form on ASQAnet, that'll actually, if you're having sort of a wholesale change of shareholding, then that'll need to be submitted by representatives of the current owners, because they'll be the ones who have access to the ASQAnet portal. So in that instance, the seller and buyer will need to work together to gather information required for that notification of material change form and the relevant supporting evidence, and that'll be submitted by the current owner. And then the new owner will get access to the ASQAnet portal after the change of ownership has been recorded in ASQAnet. So just in what else has not changed, the notification on the form via ASQAnet, it still needs to be accompanied by a fit and proper person declaration, and I've provided a link in the slide here. And that needs to be provided for any owner that owns or has increased their shareholding to 15% or more. The other thing that still needs to be attached is an Australian Security and Investment Commission, or ASIC, current and full historic company extract, and that will just list the details of what shareholdings have changed for us. And that might be required, that extract, for the company and their ultimate owner if you've got a more complicated ownership structure where you've got companies owning companies. And you'll need to provide an organisational chart that reflects the new ownership structure. So now we're going to go through all of the changes in detail. So there's new notification timeframes for CRICOS providers. If you're a CRICOS only provider, or you're registered as an RTO and a CRICOS provider, ASQA has to be notified about the change of ownership as soon as practicable, and it has to be before the change takes effect. Now, this is actually a requirement under Section 17 of the Education Services for Overseas Student Act, or ESOS Act. So specifically, it's Section 17A, subsection 3. And that's why this timeframe and requirement is different to the VET Act, because the VET Act has different wording and requirements that apply if you're an RTO only. Now, because you need to notify ASQA before the change has taken effect, we do understand that you won't have the ASIC extract, the historical and current company extract, which shows the change has taken effect. So you'll need to provide that to us after the change has taken effect. So that slide I was just talking about only applies to CRICOS providers. So the other changes that have come into effect, what this slide talks about, these only apply where there's been a significant change of ownership. So we mentioned before that significant means more than 50% change of shares over a 12-month period. So the new evidence requirements that now need to be provided with the notification of material change form on ASQAnet are a self-assessment tool, and that will be the provider demonstrating their compliance with the relevant regulatory frameworks, and they'll be providing supporting evidence with that. And they'll also need to submit a financial viability risk assessment tool, and there'll be supporting evidence with that. I'll go into these in a bit more detail now. So the self-assessment tool, let's talk about that first. So going through this, it will actually guide you through the process, either as a existing RTO that's having a significant change of ownership, or if you're purchasing or acquiring the shares of an RTO, it'll guide you through the process of making sure that the training provider is compliant with the relevant requirements, and that'll either be of the VET quality framework or the ESOS framework, depending on what the provider's registered for. So the self-assessment tool actually unpacks key standards into a self-assessment checklist. And because of how the checklist is built, it's actually a useful or educative tool because it allows the new owners to make sure that the training provider they're seeking to acquire or have acquired is actually resourced and able to deliver quality training and assessment. As well as working through the checklist in that self-assessment tool, you'll need to provide supporting evidence with the tool, and the tool itself will identify to you what needs to be attached. So there's two tools listed on the screen. The top one, you'll complete that if you are an RTO only, so you just deliver VET courses, or if you're an RTO and CRICOS provider. The one on the bottom, which has ELICOS in the title, you'll only complete that tool if you're an ELICOS only organisation that's registered with ASQA. You'll need to provide responses in the tool for your full scope of registration, so all the courses that are on your scope of registration. The tool's separated into two sections, Section A and B. Section A is quite a short section, and it's only required to be completed, all providers will complete Section A, but it only covers clauses 1.1, 1.2, 1.3, and 7.2 of the standards for registered training organisations, and if you're filling in the ELICOS version, equivalent clauses. Those clauses are really focused on training and assessment strategies, amount of training, whether resourcing, and financial viability. So everyone has to complete Section A. And Section B only needs to be completed by providers who've changed 100% of the shareholding within the RTO or CRICOS providers, and they have no ongoing students, or they have not had more than 10 students complete the training product in the last 12 months. Section B covers a much broader range of standards, and Section B more closely mirrors the evidence that's required as part of the initial registration application. So the financial viability risk assessment tool is also the other required evidence if you change ownership. This tool guides you through the process of considering key expenses faced by RTOs and CRICOS providers, and it looks at your revenue forecasts for the next 2 years. The tool assesses financial viability risk by evaluating the likelihood of business continuity and capacity to achieve quality outcomes. So it takes you through, the tool will actually break down revenue that you'll earn as a training provider and also the key expenses. So just to sort of put that into a bit more context, training provider, training revenue, or the fees that you charge students, that's really your key revenue. And the key expenses that you might have as a training provider are administration, support, and management staff costs, trainer and assessor costs, the costs of leases, venue hire, equipment, learning resources, and consumables to provide training, and even things like commission to third parties used to recruit students, and fees that are required to keep your organisation registered with ASQA. So that they're just a few examples, but the tool will actually step you through that and check that the business model, if you like, that you're using but for your RTO or CRICOS providers meets the financial viability risk assessment requirements. So this slide just explains in a little bit more detail what the financial viability risk assessment judgment is about. It's essentially checking that you're able to maintain maintain quality delivery of all the qualifications on your scope of registration so that you can keep employing qualified staff and you can provide appropriate levels of student services and you can remain in business even in an unsure environment. So in terms of completing the financial viability risk assessment tool, this would be completed by the new owners or the owners once the changes have occurred, acknowledging that there might be some old owners and some new owners on board. But essentially it's completed showing the new position of the organisation. You need to select the tool type of new registration startup business on the first tab of the tool, and that will just change the tool into only looking at forecast revenue for the business. And you'll need to get a registered accountant who's external and independent to certify the tool to sign an accountant certificate. Once you've completed the FVRA tool, make sure that you have a look at the results tab, and that'll indicate if the tool is complete and ready to submit. On the left, I've got a little snip there of what the tool looks like when it's incomplete. So it's got a grey incomplete rating. And on the right, you'll see we've got an orange rating with a recommendation to submit the tool. So if your tool looks like the diagram on the left where it says it's incomplete, please don't submit the tool to us. Go back and look at the results tab, and that will identify what fields or tabs you may have missed that's causing the tool to rate as incomplete. The FVRA tool will also let you know what attachments are needed. These are listed on the first tab, the Provider Details tab. The standard evidence requirements that you'll need to provide with the tool when you change ownership are a business plan, bank statements, the accountant certificate, and a deed of guarantee if that's relevant. So you've changed ownership, you've submitted your material change notification on ASQA, you've put in all of your evidence with that. If you were a CRICOS provider, you did that before the sale occurred. If you were an RTO, you did that within 90 days of the sale or assigning of shares having occurred. And now all the information is sitting with ASQA and we've checked that it's complete. ASQA will then do a compliance audit in response to that significant change of ownership. And that compliance audit will look at the self-assessment tool, the financial viability risk assessment tool, and all of the evidence provided with it. And we'll be checking compliance via a compliance audit. That'll normally be a desk audit, but on some occasions that might be a site visit. So that audit will consider all training products on your scope of registration, and it will check that you're sufficiently resourced to continue providing quality training and assessment and provide adequate support to students. So the audit will generally align to the clauses that you've submitted evidence for in the self-assessment tool. So I mentioned before that most people changing ownership, so the ones who are not changing 100% ownership with no students, will only be filling in section A of the self-assessment tool, and that covered clauses 1.1, 1.2, 1.3, and 7.2. So most of these desk audits will only focus on those standards, but if you do need to complete section B of the self-assessment tool, your audit will be broader, and if there's any risk factors that are identified, we might choose to change the scope of that audit to be broader. So the relevant frameworks that you need to comply with if you're an RTO or a CRICOS provider are listed on this slide. These should all be clickable links in your PDF version of the document, which you should have access to be able to upload, access to be able to download as part of this webinar. if during the compliance audit, if we do find non-compliance, then we'll take proportionate regulatory action. Now, if we just find minor non-compliances, quite often that will be a written direction, which to us is a low-level regulatory response. So we'll write you a letter advising that we've found non-compliance, and we'll direct you to rectify the non-compliance, but you won't be required to submit the evidence back to us. Essentially, we're trusting that the non-compliance is minor and that you will fix it, being given that direction. So that might be one option. But if we do find non-compliance which is more serious or concerning, then we might issue you an intent to sanction. So that might be proposing to remove training products from your scope, suspend your scope, or cancel your registration. It's all proportionate based on how serious the non-compliance is that we identify. You will be given a chance to respond if we do issue you with an intent to sanction. So you will be given a chance to respond and to correct any non-compliances identified before we do make the final decision. The other thing to be aware of is that a compliance audit is actually a chargeable activity for any RTOs. And at the time of this webinar, the hourly rate for an audit per auditor is $275 an hour. So we'll issue you an invoice on conclusion of the audit activity. So just be aware, the audit that happens will result in an audit charge because it is a compliance audit. So one of the other changes that is occurring is there's going to be increased scrutiny for people who change ownership 12 months after that occurs. So if you've changed ownership and you're submitting an application to change your scope of registration, so what we're talking about here is expanding your scope. You might be adding an application in to add new qualifications on. Maybe you've got business on your scope of registration now and you're seeking to add on some marketing qualifications. Then that is a slightly higher risk because you've recently changed ownership. So there's an increased likelihood that that may require an audit. It's not a guaranteed audit, but just to make you aware that we're increasing our scrutiny on change to scope applications within the first 12 months of a change of ownership. And the second thing that we'll do is named on the screen as a provider review. So essentially, we're going to just have a bit of a look at your organisation from a risk perspective 12 months after we've completed the audit activity. That's really just looking to see if everything's ticking along fine or if we've identified any behaviours of concern that might warrant us needing to come out and do further audit activity on you. So the things that you should consider if you're thinking of purchasing or acquiring an RTO or a CRICOS provider is the compliance history of the organisation that you're purchasing or acquiring. So as soon as you have purchased or acquired an RTO, you're actually responsible for any of their current or outstanding non-compliances and rectification actions required. So if you are purchasing an RTO, you would want to be aware of whether ASQA is taking any regulatory action or considering to take any regulatory action on that organisation. And ways you could do that is you could ask the previous owner for copies of their most recent audit reports. And if ASQA has made any decisions on the organisation, we do publish those negative regulatory decisions. We do publish those on our website. So the scope of registration as well is worth thinking about if you're acquiring or purchasing an RTO or CRICOS provider. Are you actually resourced to keep providing everything that they have on their scope? Because that is ASQA's expectation, that you're resourced for everything on your scope of registration at all times. If you're not intending to deliver some items on the scope of registration, so maybe you're not intending to deliver business qualifications and they are on the scope of registration, we do suggest you consider taking those off your scope you can always re-add them at a later time through a change to scope application. So you'll also need to make sure that current enrolments are honoured, and that includes for students under 18, they are subject to additional welfare requirements, particularly if they're international students who are here on CRICOS. And student records, you just do also need to consider those. So RTOs have an obligation to maintain registers of qualifications and statements of attainment for 30 years after the date one of those things is issued. And if you're purchasing the shares of an RTO, you're taking on that legal requirement. So you'll need to make sure that you have access to the records and that you can maintain those for 30 years from the date at which they were issued. So just a couple of slides on the obligations of being an RTO if there's people in the webinar who are not currently an RTO. So we do issue this RTO obligations checklist each year, and there will be a new one coming out that will have the year 2020 on it with relevant dates. So you do need to submit an annual declaration on compliance to ASQA by the 31st of March. And this annual declaration is to confirm that you'll meet requirements of the RTO standards. You do need to submit a total vet activity, a VETMIS data by the 28th of February every year. You need to submit quality indicator data to us by the 30th of June. Annual registration charges are due by the 31st of July each year. And just note there that separate charges will apply if you have an RTO and CRICOS registration. Of course, you do need to ensure compliance with the vet quality framework at all times. And just be aware of the organisation's expiry date, because you must submit a renewal application at least 90 days before the organisation expires. So in terms of obligations on CRICOS providers, there's also an annual registration charge for CRICOS providers, and there are some fees that apply that must be paid to the Department of Education that are listed on the screen. So that's the annual registration charge and the tuition protection service levy. Of course, you need to ensure you remain compliant with the ESOS framework at all times, and the same requirements apply around submitting a renewal application 90 days prior to expiry. So I have tried to answer some questions in today's workshop, and I'll certainly through the slides, and I will be looking at your specific questions in a moment, but I would direct you to the useful resources that I've listed on this slide. Again, these are hyperlinks, and the guide to change of ownership describes what has changed on the 31st of October. So you might find, if you have any questions after this webinar, that has answers in there for you. The fact sheet around change of ownership is directed to people who are thinking of purchasing the shares of an RTO or CRICOS provider. And the two self-assessment tools and the financial viability tool we did speak about during this webinar. So I can see that some questions have been coming through as I've been speaking. I'm going to seek to answer these now. So if there's a little bit of a pause while I do read through them, just bear with me, please. And if you haven't submitted a question but you'd like to, then please go ahead and put that in now. Okay, so I'm going to answer a question that's been put through. So the question is, do the new evidence requirements apply to significant changes which occurred prior to 31st of October, even if the material change notification is provided to ASQA after 31st of October. So these changes apply to sales that have an effective date of 31st of October or later. So if, for example, if you have an effective date of your sale, which is the 20th of October, and your ASIC documents support that, then these changes do not apply to you, even if you have to lodge the material change after the 31st of October. So the 31st of October is all about the effective date of the sale, not when you submit your material change notification to ASQA. Okay, so we've got another question here, and that is, what is the requirement for a change of ownership of shares where less than 50% of shares have been sold over a 12-month period? So if you change ownership more than 15%, then you must notify ASQA of that change, because that's called a material change under the Act, and you notify ASQA of that via that material change form that's on ASQAnet. But because it's less than a 50% share transfer sale, then it's not considered to be a significant change of ownership, and the new evidence requirements that I've spoken about today, such as the self-assessment tool and the FVRA tool, don't apply, and the audit generally doesn't occur. But ASQA may audit any RTO on a risk basis at any time. Okay, another question that I'm going to answer. So this one is just checking, if there are no students but 100% transfer has occurred, then does section A and B of the self-assessment tool get completed? That is correct. So you need to complete both section A and B if the transfer is 100% and there are no students. That situation will quite closely resemble ASQA's process for initial registration. So essentially the standards that we check and the scrutiny applied is quite similar. So there's another question here, and it's essentially asking, we won't know the cost of the audit until it is done. So that is correct. ASQA is not able to give you a quote or that type of thing up front on how long a compliance audit may take and therefore might cost. That is standard across all audits that we do. ASQA does only audit providers on a risk basis, and if your provider is significantly changing ownership, that is a risk that ASQA thinks is a risk. And also under the Act, we are required to charge for compliance audits. Because it is a desk audit and it does generally a desk audit, and it does generally only focus on a limited number of clauses, the cost of the audit, because the time taken to look at the evidence, will likely be substantially less than, for example, a site audit that looks at a whole range of different standards. The next question is just about seeking clarification about what we're talking about when we say 12 months. The change of ownership, the increased scrutiny on change of ownership will generally occur within 12 months of the date that the material change notification is processed. So it'll kind of align to the effective date of when the sale occurred. And the provider review is generally 12 months, occurs 12 months after we've completed the compliance audit that looks at the additional evidence, noting that that only happens if you've got a significant change of ownership occurring. Got another question here about fit and proper person. Is there more information available on fit and proper person? I would advise you in this case to actually go and look at the fit and proper person declaration form. That's got quite a bit of detail in there about who needs to fill in the fit and proper person declaration. And you'll be able to see the range of questions that we're asking. So essentially that'll give you a sense of what we're seeking to assess with that. If you have any more questions, I do like specific questions. Once you've looked at the fit and proper person declaration, I do suggest that you contact the inquiry line. So we've got a question here. How long in advance should the notification be provided where you are both an RTO or a CRICOS provider? If you're an RTO and a CRICOS provider, you have to comply with the ESOS Act and the NVR Act. Now, because you have to comply with the ESOS Act as well, then you must submit the notification prior to the effective date of the sale. I've got a question here. What are the requirements for the business plan? Should this be prepared prior to the sale by the seller? The things that we need the business plan to outline, they're actually detailed in the financial viability risk assessment tool. So if you look on the information tab of that tool, when you open it up, it does detail what the elements are that the business plan needs to contain. Should this be prepared prior to sale by the seller? All I can tell you there is that we will need it submitted with the FVRA tool, whether the seller has prepared it or it's a combination effort between the seller and the purchaser. That's a decision not to be made by ASQA. So I've got a question here. It's asking what happens if the material change is submitted to ASQA and then ASQA, will ASQA ever decide that the sale cannot proceed? Obviously the sale's already gone ahead and you're telling us after it's happened, so that's not quite how things work. So essentially the notification of material change form is sent in to us. ASQA is then going to do an audit of compliance of the RTO or CRICOS provider. And if we find non-compliance at that audit, for example, we've got concerns that the new makeup of ownership does not meet the financial viability risk assessment requirements or is not compliant with the standards, then we will take proportionate regulatory action. And as I mentioned before, that might be if it's minor non-compliance, a written direction, or if it's significant non-compliance or serious, that might be an intent to sanction. So the worst case scenario is if it's very non-compliant, that we might intend to cancel the RTO or CRICOS provider because they don't comply with the relevant regulatory frameworks. But assuming that the organisation is compliant, then we will not. There's no avenue for us to say the sale cannot proceed. Okay, if we've got any, does anyone have any other questions that we haven't answered yet? Please send them through. And just a reminder that we might not answer every question that's come up. We're trying to answer those that are of a general nature that will be useful for all the participants to hear. Sometimes some of the questions submitted might be very specific to an individual case, and they'd be the kind of things that are best directed to the inquiries email box. And I've given you the phone number or the email avenue to contact them on the screen. Okay, so just a reminder, a recording of this session will be emailed to attendees over the next few days. I'd like to thank everyone for attending today's webinar, and if you have any further questions that we weren't able to answer, you can contact the info line and the details are on this slide. Have a great day.